How many shares of QQQI, the NEOS Nasdaq 100 high income ETF, would I need to hold in order to make $500 every single month from dividends? Welcome to the channel, guys. I appreciate you guys being here. If you guys are fans of QQQI, of dividend ETFs, of stocks, of ETFs, of dividends overall, you are in the right place. Consider subscribing if you find this video useful, but we're going to jump right into it because I don't like long intros. So if you are either new to QQQI or you're familiar with it and you just want to see how much money you need, I'm going to do timestamps so you can check the video out down below if you want to jump around. I am going to talk a little bit about QQQI. It is a very new fund, so I'm guessing most people haven't heard of it. Now, it pays out a monthly distribution. They're not technically called dividends from this ETF, but they are distributions, same kind of thing. Has a little bit of a higher expense ratio, about 0.68. Not terrible. The YieldMax ETFs are significantly higher, but the actively managed funds are a lot harder to control. And so that is why the expense ratios are higher on those. The distribution yield is about 14.5%, which is insane. Most of the time when I look at funds, if they're over 8 to 10% in dividend yields, I am out. That is a big red flag, especially if they don't have the NAV to cover it, the assets to cover it. But QQQI is very, very different, and these NEOS funds are extremely interesting to me. So net assets, they have 331 million. We'll talk a little bit about this, the benefits of QQQI. Now, for those of you that know of QYLD, I used to be a big fan of QYLD, and then I bought it. And so I held QYLD for a little over a year, and I was barely even on it. And I know that some people are huge fans of QYLD, and I'm not bashing that fund at all. But for me, when you have a fund that is specifically supposed to be paying out high dividends and you're ending the year, now I was reinvesting dividends as well. So I would buy more of the stock every month, but then it would continue to downtrend. So I was just even. It was like just having my money in the bank almost, but higher risk, so even worse. And so I wasn't a fan of QYLD. After that, I did sell it and I put the money all over, but I recently purchased QQQI after the success that I saw with SPYI. Both of these funds are newer and they're higher risk. You need to know that when we have new ETFs hit the market, even if there's a lot of money in them really quickly, even if there's a lot of hype, it is higher risk. You need to see the history of an ETF, of a stock, of a company perform. It helps you dictate or estimate how it's going to do in the future, although it's not always perfect. But it is a useful thing to see. If you see a company that is 1 year old that has never cut their dividend versus 20 years old that has never cut their dividend, you can assume the 20-year-old company has 19 more years of experience. And so that's what I mean by that. So QQQI and the SPYI strategy, they are similar. The fund seeks to distribute high monthly income generated from investing in the constituents of the NASDAQ 100 index and implementing a data-driven call option strategy. So they're writing calls. Actively managed by NEOS. That's why our management fund is so high. The expense ratio, or is that what it is? Expense ratio, yes. Seeks to take advantage of tax loss harvesting opportunities in addition to utilizing the NDX index options classifications. So it's subject to lower 60/40 tax rates. And now taxes are one thing that's really, really important. I do most of my trading in a Roth IRA, so I am tax exempt in that account. But I do have other brokerages that are not tax exempt. So it is important to note that the tax benefits here, they're nice. They are not going to make a super substantial difference in your overall take home, but it is nice knowing that you have some tax benefits with funds like these ones. Now, the fund utilizes a call option strategy that may include both sold and purchase NDX index options, which may provide the opportunity for upside capture in the rising equity market. So the one thing that these NEOS funds do is they seek to generate money from the QQQ or from the NASDAQ 100 going up, as well as from the calls, which is very, very different from most ETFs. Most ETFs, you make money off of what you're making from the options. And so it's higher risk, but this one tries to do both. And so far it has done well, but we will see what it does in the future. And so the key investment objective is to generate high monthly income in a tax-efficient manner with the potential for equity appreciation, meaning that as the NASDAQ 100 goes up, this fund will follow, and you will also make those dividends. Now, it's still going to be a dividend fund. That is for sure. You're not going to get a 15% dividend yield or distribution yield and make 20% a year, because then you're making an insane return on capital. They're focusing on the dividends with some appreciation. Now, any appreciation is nice. In my opinion, if this thing was positive by 1 to 2%, that's a huge win for me. The price has gone up by 1 to 2%, and I'm yielding 14.5%. That is key because, like I said with QYLD, we had like a 12% yield, but it was going down 10, 11% every single year. So you're yielding about 1%. This is trying to do the opposite of that. Jumping into their dividend history. Really, really important. So like I said, they've been paying since January. Their first dividend payment was in February, and they paid 59 cents. March was 60 cents. April was 59 cents. May was 61 cents, and June was 62 cents. Went up a little bit, which we love to see. Again, only 5 dividends, so there's not a lot of dividend history here. But what we can do is let's calculate what this is going to be. 1, 2, 3, 4. We have 5 dividend payments. 596, 596162. Okay, so 0.59, 0.59, 0.60, 0.61, 0.62 equals, what's that put it? 62, 61, 5966. Okay, 22, yeah. So we have 3. And so what we're going to do is we're going to divide this by 5 to get our average. And that's our monthly average. If this keeps up, we'll multiply this by 12. You have $7.22 per share. And now what is the current price? I do not even know. Look at this. I don't even know what the current price is. $52.90. So if we pull this up and we divide this by $52.90, you have a yield of about 13.5%. So the yield on their website is a little bit low, potentially because it's not updated as to their last dividend, but still a pretty phenomenal return. 13.5%, and that again is not including the price appreciation that we've seen year to date, which is 6%. So you're looking at 19.5%, which I'm pumped about. Again, people get upset if they're not exact with the, I definitely think they overestimate on their websites. Typically, I've seen that with the YieldMax funds. We've seen it with a lot of these funds, but all in all, I'm happy with this. We are on Dividend.com with their Reinvestment Calculator tool. I cannot speak today. Forgive me. Maybe it's because it's like 113 degrees where I live. Anyways, before we jump straight into the calculations, which we've already done one, I want you guys to know that this is just speculation on what this fund could do. This is not advice, financial advice that's saying it will do this or that it will keep up this yield or that it's going to keep up the price appreciation. We really don't know. So jumping in, $1,000 invested with the 14.48%, you know that's pretty simple mental math. We're going to get $144.80. And now if you do this over a number of years, that would definitely do better if you were going to reinvest those dividends. The reason I started this series was because I had a car payment that was under $500, but I wanted enough dividends to pay my car payment every single month. That was kind of my goal, was to see how many of these shares do I need to pay my car payment. And so the $500 ends up being $6,000 every single year, which is amazing. That is a lot of money. And so at $5,000, you would make $724 every single year. Now let's jump this up and let's jump to $20,000. So at $20,000 at a 15% return, you are now making $2,800, almost $2,900 every single year, which is crazy. Really, really crazy, because you're only investing $20K for 1 year and you are making almost $3,000. Really solid return. So we can tell that we're going to be right around $40,000 for our mark, maybe a little bit over. Let's do $41,000. Damn, not quite there yet. $42,000. This is going to go over. So now at $42,000 invested at a 14.48% rate of return, this would get us that $6,000 a year, which equates to $500 every single month, which is what we are looking for. Now, this is not counting price appreciation. If it also goes up 5 to 6%, like we saw at the beginning of this year, and maintains a 12% rate, you could even cut this in nearly half, and you would get there with $30,000 roughly. So it is really, really cool to see how these funds perform overall and how $42,000 can end up paying for your car payment or getting you $500 in dividends every single month. Now, you're going to have money lost on taxes, and You can sell stocks to offset that. I'm no tax expert, but one thing I do want to note is, let's say you invest $10,000, not 41. Let's say you invest $10,000 and instead of 1 year, you do 10 years. At this rate of return, at a near 15% rate, at 10 years, if you're reinvesting your dividends, you are now making $4,800 every single year in your dividends. And this shows you that time is one of the most powerful elements of the stock market. Compounding interest will make millions. It has made millions. It has made billions. It might even have made trillions. But just remember, your time in the market is going to be better than picking and choosing little stocks or trying to time the market. Really, really important. So after 10 years of 10K invested, you're now making about $4,900 every single year in dividends, and your total return is $28,000. You have a 300% return, a little bit under 300% on $10,000 in 10 years. And that is hard to do. Nvidia and Tesla and these stocks that we've seen doing this, it's rare. I promise you it is rare. So this is pretty phenomenal that this fund could do it. And again, this is just including the dividends. This is not including the price appreciation. If you added even 10% every single year, you're crazy increasing. You'd be at over 400%, over 500% even. So the final calculation, if you needed to invest, let's say it was $42,000 to make our $500 every single month, dividing this by the current share price of $52.90, we get 793 shares. A pretty solid amount of shares, definitely a lot. This is still a lot of money. $40,000 is not chump change by any means, but compared to how many shares you need to own of other companies and the amount of money you'd have to put in, this is looking pretty good. I really appreciate you guys for staying to the end of the video. If you are interested in stocks, finance, money, especially dividends, I've been on a dividend kick for the last couple of years. Consider subscribing to the channel. I put out a few videos every week and some shorts ever so often. So I appreciate you guys regardless. Hit that like button if you did enjoy, and I will see you guys in the next one.